Thank you very much to everyone in the auditorium for joining us today on what should be a good session about getting active on owner and manager alignment. We not only have the audience in the auditorium here today, but this is also being live web streamed, so my welcome to those people who are watching us through a computer screen. So before I move on to the speakers, a few housekeeping tips. Those people who are watching it through the live webcam, as well as the people who are here, can actually ask questions using the app, so you can do it anonymously. You can also type into the website any questions you might have, and I have been given this to try to put some of your questions to the speakers. So I'm very pleased to be chairing this today, thinking about how we encourage asset managers and other people throughout the investment chain to really invest in line with asset owners' long-term time horizons is something that is very important to us. And I'm really pleased that we have two experts here today to talk to us about this. So first up, we have Carol Geremia, who is President and Head of Global Distribution at MFS Institutional Advisors, who has joined us from America. So thank you very much, Carol. And we also have James Duberly, who is Director of Pensions Investments at the BBC Pension Trust. So without further ado, Carol, you're going to talk us through giving us a little bit of information about how misalignment can result in missed opportunities, and then James will talk us through sort of your BBC pension scheme perspective.
Great, thank you, Caroline. Good morning, almost afternoon, but good morning to everybody. I am so delighted to be here, and I've got some big ideas and big issues to share with you in a very short period of time. So I'm going to get to it right away and really address what I have been having conversations with so many people around the world, so many investors, asset owners, and what I would tell you about it is that I have been extremely inspired by the conversations because for some reason, I don't think I'm alone in terms of wanting to address this and talk about it. So I am going to get to a little bit of the dilemma. I will address why I think investors are out of sync with active managers, but it is more broad than just any active or passive debate. The next is really why it's so important that we start changing the dialogue about this and hit it head on, because the investors we serve are losing the opportunities as we become more and more misaligned. And then finally, how do we course correct? What are we doing today that we can change? And quite frankly, a lot of it, I look inside our own organizations and realize we've got to step forward and do a lot of changing ourselves. So why the misalignment? I think it's really important just to look at why we are where we are today. Because in order to see where we are and why we are here, it's a lot easier to actually fix it. The investment chain, and a lot of investors are talking about this, has grown quite long. And what I would say is the chain is breaking, if not broken. The regulators know it, investors feel it, and the industry is really, truly trying to figure it out. And what I think we have a tendency to do when we're in this set of confusion and growing misalignment, it's very tempting to point fingers. And I actually think it's not about pointing fingers, because we all own a piece of it. One thing that is interesting to me, and a lot of the work that I'm going to talk to you, I really relied on outside sources, and it was helpful because, again, some of the research that's being done around the growing misalignment is awesome, and I'm happy to share any of the papers with you. But one of the things that is clearly pointed out in many of the papers is that the public markets today, almost close to 80%, if you're looking at a global number, 80% of the public markets today are owned by institutions. And that includes mutual funds, pension funds, sovereign wealth funds. But 80% is owned by institutions. And essentially, if you look at then the average holding period, what that is doing is breeding a tremendous amount of short-termism. And in fact, the institutional ownership is really corroding capital commitment. So when we think about the importance of stewardship and the importance of sustainability, the importance of long-term value creation, a lot of the chain and this ownership change over time has eroded that capital commitment. On top of the fact that we've got misalignment and the investment chain is starting to break apart, we also obviously have the challenges of the market. And you could argue that this is driving a lot of the misalignment. So just this slide alone gives just a quick snapshot of the idea that investors are taking 3 times the amount of risk to get the same amount of return. So as asset owners, we're sitting in a highly complex environment now in order to take risk. And clearly what's happening, a lot of times when you take on more risk, it does increase uncertainty and misalignment. So one thing we started to really look at was as you looked at risk allocation and said, well, if we're dialing up all this risk in terms of reaching for return, investors are doing a number of different things. You can either go to bulk beta, passive investing, alternative beta, and what I see in huge increase in pacification of capital is not simply that people are doing it to have lower fees. If you even put fees aside for a moment, I think actually the movement to passive is because investors are not being given the time to get the outperformance. On the other end, we see a lot of growth in alternatives and illiquid assets. Great idea, obviously, for diversification purposes. But what most investors know when they're moving to alternatives is, yes, I still believe that I can get outperformance. But I know one thing very clearly, and that is I need time. I need time in order to get that outperformance. So we've moved to this illiquid premium, but we have actually foregone liquidity. Then you add the ESG, sustainability conversation, and what really troubles me there is that we're treating it as if it's a separate outcome. And so my question to investors literally around the world for the past 2 years has been, is liquid alpha still possible in a world that has become so short-term? Because liquid alpha is really about protecting your liquidity, but also believing that you can get outperformance. But unless we change the dialogue about protecting our liquidity and the ability to outperform markets, we are not going to be able to get the best out of liquid alpha. And I'll show you what I mean. What we did a lot of work around, and we were looking at not only the active-passive debate and realizing, you know what, that's actually not worth the time to sit and have active versus passive debate when both strategies or types of investing need to exist. What we really said is the most obvious area, especially if you're an asset manager, obviously a lot bigger and broader for asset owners, is the biggest area of misalignment is clearly time horizons. So if you look at an asset manager, most of them say our ability to outperform, or our goal is to outperform the markets, but we'll do it over a full market cycle. And when I looked at our own organization, we said it everywhere, in all of our books and in all of our client review material, but we didn't really define what a full market cycle was. So we did a lot of work. There's actually an amazing amount of information out publicly about this. But if you look back 100 years and you really tried to define a full market cycle, it is peak to peak, trough to trough. It's not one side of the cycle. And this is critically important because I think when we're engaging with clients, people are forgetting both sides. If you look at about 100 years or more, and depending on drawdown, a full market cycle ends up being between 7 and 10 years. And we not only did a lot of work ourselves, but we then started asking the question, where do we come up with the 3 and 5? So I was very curious to see what did other investors around the world think about a full market cycle? What would they define it as? So 3 years in a row, we've gone out to institutional investors all over the world and said, what is your definition of a full market cycle? And the answer we got back, and I was surprised about this, is that the answer mostly, generally, was greater than 7 years. And in fact, the last couple of years, it's declined, but generally it's still, the majority is over 7 years. However, we did a follow-up question and said, how long are you willing to tolerate underperformance of an external manager before you put them on watch or fire them? Clearly, in every region in the world, it was dominated that 3 years was the tolerance period of time. I am not suggesting in any way, shape, or form that the 1 year is wrong, the 3 years wrong, the 3 years right, 5, 7. I'm not even suggesting time horizons right or wrong around measurement. What I am suggesting is we have a very clear misalignment. When we say long-term as an asset manager, we need to be more clear. Because this is what happens, and this is what's happening in the industry. The IMF did a phenomenal Bradley Jones about the procyclicality that's happening in the institutional marketplace. And it's essentially the herding. We are spending so much time chasing short-term past performance. And here's a great, I use this from another manager in the US that defined market cycle, great paper from Manning and Napier, that essentially every 5-year period of time, when we go after our top quartile managers, within that 5-year period, more than 50% of them are dropping to the bottom half. And this churning that the IMF talks about, hiring and firing active management all at the wrong time, is costing investors anywhere from 80 basis points to 150 basis points a year. So you see this obviously chasing past performance around 3 and 5 years. I did have an investor say, geez, Carol, tell me what happens to the bottom quartile. What happens to that group of investors? And ironically, I didn't know. They asked me to run the numbers. I ran the numbers, and it's the same thing. So what I would suggest to you is it's not that you didn't hire or find skill. It's that we really haven't given the extended time that's needed to get the skill that you're looking for. Most people say, gee, Carol, this sounds really self-serving. And what I would suggest to you, even as an active manager, it's more self-serving, and it has been more self-serving for us to not have this conversation about time and being more clear about being long-term. So how do we course correct? It's really about what I think is going to be the future, and this is what is inspiring to me, is that a lot of the innovation we're going to see in this industry is not product proliferation. We've got to stop building products to say, we're going to be able to make money for you in a shorter period of time. It's not true. What we need to do is actually figure out the innovation around pricing, incentive alignment, and measurement. So I don't have a lot of time. This presentation is usually about 30 minutes, so I'm just going to crank through a couple of things to think about as we course correct. As we think about the 3 and the 5 year, if a full market cycle is truly 7 to 10, we need markers to the longer-term destination. 7 to 10 years freaks people out many times when they say to me, geez, that's just too long. But ironically, we've got to figure out that marker to the longer-term destination instead of making the 3-year number the destination, which it's become. Who is defining time horizons as you're measuring external management? Are we really looking at the full market cycle and understanding when we hired them and or where we might be in the cycle based on their performance? You look at benchmarks. We use that as the metric for everything. And so many investors are today saying, how can I actually keep investing or comparing against a price momentum biased benchmark? When that really isn't looking at the risk I'm investing in, even in the benchmark alone. And then finally, we talk about high active share. It's the new trend to really identify skill of active management, which actually it's great to identify conviction. The problem with high active share is that if you don't have a manager, if you have a manager that has high active share, they have to have low turnover in order for it to work. Take it one step further. If you have a manager that has high active share, great conviction, low turnover, you're probably going to get great long-term returns, but you need to make sure you view their performance over a full market cycle, or you're not going to get or reap the benefit of that skill. So here, just bringing it together, the importance of leveraging a cycle. I have used this slide. Again, it's not an MFS slide. I took it from another manager. It is a great way to educate boards or people that are struggling with the idea of extending your time horizons. What it shows you is the red bar is the market. We have a correction, then we have recovery. We've been in, obviously, a long period of recovery right now. The blue bar is the opportunity for alpha. So guess what happens? If you've got really strong skill of managers that know how to take countercyclical risk, you essentially get hired right at the bottom after the correction. Financial crisis was a great example. That's when we saw a huge influx of money into our global equity strategies. Because what we demonstrated through the financial crisis was not a few basis points of outperformance, hundreds of basis points after the financial crisis. Everybody loaded up, have had the opportunity to grow, and where you really start to have the dilemma, and this, you can look at this cycle, you can look back at the tech bubble, people start to question whether actually active management is working. When in reality, this potential negative alpha in this shorter period of time could be the most important thing you pay for. And I'll show you in a minute how that looks. But I do want to say, and I want to finish up by saying, it really is about understanding what you're hiring an active manager to do. And let's face it, today, assessing active management has changed completely. And we need to have a new lens. We need to have a new dialogue, because technology has disrupted the entire industry. You could argue it's a big part of short-termism. But when we look at what technology and having an information advantage today, it just doesn't exist. We are in an information democracy. So you have to ensure that your active manager truly has the ability to have an analysis advantage. And that's going to come from the things that actually, unfortunately, are very difficult to measure. But it is the blood, sweat, and tears that everybody does in the search process to identify the skill, focus on long-term value creation. Does this manager truly believe it, and can they prove it? Do they have culture that supports the best sharing of information? Do they really build teams and they're not built around personalities? To invest in a personality today is not possible. It really needs to be identifying teams that can make effective decisions. And then finally, obviously, having a global view. But what I would say here is long-term discipline. So many investors don't even look at holding horizons as a key metric to identify or understand if you have skill. Because turnover today, again, is something as a metric that isn't used as much as it should be. Holding horizons is more powerful as a metric to assess skill than turnover. And the Harvard Business Review did a great paper on looking at holding horizons. And what I would suggest is when a manager says that they are long-term, it's one of the most important metrics to take a look at. What is your average holding horizon in your portfolio? If they say that their holding horizon is 7, 8 years, then that is a clear indication as an investor of how long you need to potentially commit your capital to that strategy. If the holding horizon is a lot shorter, then that gives you a much better indication of, again, how the manager is managing assets. It is a completely underutilized metric, and I think it should be at the forefront before you even look at performance. I'm going to throw in 2 last pieces here. One is around ESG. I mean, this is a whole nother separate presentation. But the industry is trying to build product around ESG and sustainability. ESG and sustainability, I don't even think ESG is going to be a term in 3 or 5 years, because ESG integration is active management. If you really want to responsibly allocate your capital, have investors engage with the businesses that they own on your behalf, you have to assume or insist that they're including all of the ESG factors, the material factors as it relates to the businesses they own on your behalf. And in fact, if they're picking up just ESG in a screened way and just taking it from an index view, you're going to pick up a lot of noise and immaterial factors. Again, the importance of materiality in ESG is critical. Last slide, and I think this hits it home, and it's the most obvious, and I got it from an investor, an asset owner that sits on 4 boards. And he said, Carol, I'm so tired of having this debate with my board about how we have to extend our horizons, whether it's in hiring managers or our own investment strategy. But what I did is I wrote a paper for our board, and there was one chart in there that I asked him if I could use. He basically gave the example of Warren Buffett, and he said, if you were going to take Warren Buffett as a skilled active manager, and you looked over 25 years and took his rolling 3-year performance number to assess his skill, 36% of the time, he would be underperforming the S&P 500. I will leave you with the idea that if you're going to use the 3-year number, great. It's a marker to the longer-term destination. But actually paying for negative alpha might be, depending on where you are in the cycle, the most valuable thing you can do in terms of sticking with long-term value creation. Thank you.
Thank you very much. Thank you. So lots of food for thought there, and certainly the stuff that you're saying on ESG investment chimes in with a lot of what we've already heard about ESG being a really key investment risk, should be integrated properly. And now over to James for the scheme view, please.
Great, thanks very much. Thanks very much, Carol. Morning, everybody. So I'm going to talk just briefly about how we work with managers at the BBC pension scheme, and then perhaps after that we can pick up on some of the themes that Carol talked about. I'll see the clock. So just quick overview on the BBC pension scheme. We're about £16 billion of DB assets, closed to new entrants. Anybody joining the BBC now or today ends up in a, broadly speaking, much less generous DC pension scheme. So all assets are managed externally, so we're highly reliant on our fund manager relationships, albeit that we do have a small FCA authorised investment team. We like to say we have a coordinated approach to management of assets and risks. Say that especially with a representative of the pension regulator here. When you do long-term analysis, I think you'd see a similar set of numbers from other pension schemes, really sort of quite what I think of as remarkable, very long-term returns dating back to the 1970s, so over 11% annualised return since 1978. We're about 95% funded on a TP basis and what I would describe as partially de-risked. So with that introduction, I've got an English literature question for you. So I wonder if you just read the two quotes there. So the first one, I learnt to recognise the thorough and primitive duality of man. I saw that of the two natures that contended in the field of my consciousness, even if I could rightly be said to be either, it was only because I was radically both. And then good and evil are so close as to be chained together in the soul. Anyone know where those come from? You're too modest. So it's the Jekyll and Hyde. Well done. The strange case of Dr. Jekyll and Mr. Hyde, which I thought about when thinking about whether to make a presentation about how important and wonderful fund managers were, or the opposite. And it is very topical actually, because it's a real classic Scottish novel. So although it's set in London, written by Robert Louis Stevenson, and the inspiration he had for the novel came from a chap called Deacon Brodie, who was an Edinburgh cabinet maker who spent his day making wonderful cabinet makers for the upper classes of Edinburgh society, including Robert Louis Stevenson's father, I think, and spent the evening going back into their houses and nicking all the stuff that he thought was good. So I suppose that was what I said. I was wondering whether I should say that managers are an essential part of the delegation process, mostly ones that we come across, very skillful and clever. Usually, really, they want to do their best for their clients. And you know, from a fund manager's, from a pension scheme's perspective, we just need to make sure we hire the right one and treat them in the right way. Or do we say, you know, which I'm afraid to say is probably a reasonably broad public view, that they're misaligned, overpaid, tendency to focus on their own business interests, and the short term at the expense of the long-term interests of clients. So yeah, I couldn't quite work out which one to go for, so I thought I'd park that for the time being and talk a bit about our manager relationships. Yeah, so this is a graphic that just shows all the fund managers that the BBC pension scheme uses, and it's by asset manager, not by product. So there are some managers who manage more than one product for us, but you can see there are about 30 managers, and actually I've cut off the tail, so there are slightly more than that, sort of mid-30s, which are sort of, you know, mostly private equity managers in runoff and things like that. The manager on the left is Legal and General Investment Management, who's our LDI manager and provides other functions like equity derivatives and effectively a treasury function. The top 5 managers we have run about 60% of our assets. So the next slides I'm going to show, I'm going to cut off Legal and General, but the charts are otherwise the same. So the first thing I'd say when we sort of did the analysis is that actually the relationships we have are pretty long term. So the numbers in the managers in blue, all these individual managers, have all been in place. We all had relationships for 5 years or more, and the red ones, or whatever that colour is less than 5 years. So a lot of very long-term relationships, and indeed when you look back, there are a couple of manager relationships that we have that go back over 30 years. Next thing to say is to distinguish between managers who are traditional, what I call traditional active managers of listed bonds and equities. So people running traditional active mandates. So you can see that biggest one, LGIM, is a sort of semi-discretionary account. We call that not traditional. The largest single manager relationship we have in the red bar is PIMCO, running kind of global and UK bonds. And we then have 2 active equity managers who are numbers 5 and 6, which are Bailey Gifford and Sanders. But you can see actually across the board, not a lot of traditional active mandates and relationships. If you just look quickly at how things have changed over time, what I've done here is to break up the amount of assets, the proportion of our assets in these different types of strategies. So as I said, we have fewer assets in active listed strategies than would have been the case previously. Some of that's due to de-risking coming out of active equities as the scheme adopts, a more kind of conservative asset allocation that's consistent with the risk tolerance of the trustees and the sponsor. We have a large allocation in these sort of low discretion type strategies, passive LDI, and then a significant increase in private or alternative assets. Showing that by number of managers, you can also see that a disproportionate number of our managers are actually in this sort of private and alternative space, with a couple of managers that I've called mixed, where we're actually running a number of different mandates across listed markets and alternatives. So BlackRock, M&G would fit into that bucket. Both are running in the region of £1 billion for us, so quite significant mandates across different products. One thing I would say, I mean, a sort of theme is increasing use of alternatives and how that feeds through into our manager relationships. We've tried very hard to keep a lid and keep control of fees and costs as part of this process. So a lot of the managers that we've added, so a number of managers between about 7 and 13 are managers of strategies like private credit, infrastructure, renewables, long lease property, where we're not paying managers performance fees. We're paying fees that are kind of consistent with what you might traditionally have paid an active bond or equity manager. And it's only when you get into the sort of private equity space and more aggressive strategies that we're paying performance fees. So the overall level of fees that we pay as a percentage of assets under management has actually reduced by something like 40% over this time period we're talking about. I could stand here and sort of talk about lessons that we've learned or tips, but I think everybody has their own way of working with managers, and I'm not sure I have all the answers to give to you today. But I just thought I'd share with you some of the questions that we spend a lot of time thinking about in terms of how we set up our manager relationships and how we work with them. Do we have too many managers? Is 30 plus too many? Should we focus on specialist mandates or some of these broader manager relationships I just talked about? What should we be delegating? We've got an internal investment team of 5 people. We can't presume to do everything ourselves. What do we delegate and to who? Or at what point should we just not do it? What's the driver of manager selection? Is that about finding skill, or are we trying to source assets? How should we think about alignment with managers? Some of the things Carol was talking about. Is alignment just financial, sort of skin in the game, performance fees, or are there softer ways of finding ourselves more aligned with the managers that we use? When and how do we interact with managers? How do we present them to our investment committee? What do we get them to talk about? What do we do when their numbers are bad? Should we give them a good kicking, as I've sometimes been described, or is a softer approach better? The importance of contracts is one thing I haven't put a question mark behind. It's absolutely critical. I mean, we've had, probably, a manager we've parted company with a year or something like that, so not a very high turnover, but we had one or two very difficult situations, and in both those cases, tighter and better contracts in the first place would have been something that helped our situation. And a sort of fundamental thing, which is just really, how can we, as a pension scheme, set up the managers that we choose, set them up for success? What can we do to make sure that they are able to do a better job for us? So if I may, I'll just go back to the Jekyll and Hyde thing. So many of you may have read the book or know the story, this sort of duality of personality, the rich and worthy and respectable Dr. Jekyll and his alter ego Hyde. And the trouble was that Dr. Jekyll had tried for so long to suppress certain parts of his character that when he unleashed them, it was a very destructive force that took over his whole personality. So that's not to suggest that fund managers will necessarily meet the same unhappy end. But I just did want to leave you with the thought that all of us, fund managers, pension schemes, consultants, I think we're all faced with a range of complicated pressures relating to alignment and governance. And sometimes it's better to recognise and manage those rather than completely wish them away.
Thank you very much, James. The scheme perspective and also a brief brush up on our Scottish literature knowledge at the same time. Very, very useful.
I read it on the train up, actually. It was really good. I'd recommend it for anybody.
Very excellent. So before I take questions from the audience, I have a couple of questions as chair. So Carol, first of all, with you, all the stuff you spoke about, particularly at the end, sounds fantastic. It sounds like it might be quite resource intensive potentially. How, for schemes, do you think about managing and following through? We have a broad range of schemes here at the conference, larger ones and smaller ones, ones with potentially less access to resources. How would you recommend that smaller schemes cope with thinking about these kinds of issues?
Yeah, we're working with a lot of clients now. Like I said earlier, I've been so pleasantly surprised that investors want to have this conversation because in a way, with the roles that they sit in, they feel a bit stuck. They know that short-termism is setting them up to fail as well. So one of the ways, this is low-hanging fruit, but just the way we show up in measuring, and I think James articulated it in a way, is to show up on what we spend time focusing as we review a product or strategy or performance. Should we really be highlighting not the 3-year, but really the 10-year and looking at that first? And that's been a suggestion by many of just starting with the 10-year and reversing it on the page. The one thing we've pushed internally, I've realized that when we say we're long-term investors, when we talk about a full market cycle, why aren't we doing a better job really saying that our average holding horizons are 7 or 8 years? Mm-hmm. That's how long the conviction we have in the businesses we own on your behalf. Mm-hmm. It's not just position size in a portfolio. So these are ways that I think the asset management industry has to step up and say, we need to help you understand why we value time and why we think you should as well. And what would follow from that first conversation of alignment is clearly measurement innovation, better ways to do this, and then eventually I do think pricing innovation.
Okay, thank you. And James, one for you. You spoke about performance fees or performance fees. There has been an interesting suggestion in the media proposed by Mercer that has been stimulating a lot of conversations that I've been having here about making asset managers pay the asset owners should they underperform sort of a particular benchmark. Do you think there's any merit in that idea, or there are other things that we need to be looking at?
Oh, I wasn't expecting you to ask me about the Mercer thing. I'd have swatted up on it if I knew. I think it's difficult to get, it's difficult to expect managers to pay because, we're a £16 billion pension scheme and often the managers don't have balance sheets that could support the consequences of underperformance. I would say that we have, a number of relationships where we've got managers who have a significant amount of skin in the game, and so we think about how effective is it to have financial alignment, you know, versus other methods of alignment. And so we have, I can think of an example of, you know, US property portfolio, large, long-standing property portfolio, where the manager has, you know, effectively between 25 and 50% investment. We have the rest, so it's like a sort of co-investment or sort of partnership structure. That works very well to focus the manager on, you know, on doing the best they can for us. But I can also think of some other examples where you have private equity structures where the managers stand to lose quite a lot or gain quite a lot, and in some situations that's just gone wrong. So it's no sort of it's no sure way of I think getting things lined up financially can help, and obviously the financials matter, but it's not a sort of magic way of getting perfect alignment. And I think for us, you know, without going into too much, actually some of the things Carol talked about are more important. You know, really knowing what you're buying when you invest with a manager, whether that's a listed manager or a private market manager. When we're talking about private market space, really showing an interest in what that manager is buying, go and see the properties they're buying, go and look at the wind farms that they've got, so that you really understand what's going on. We find that generates a much more sort of constructive dialogue and much more focus, in some cases, by the manager on actually, you know, working in our interest than if we have a very hands-off way of dealing with things.
Okay, thank you. And the app appears to be playing up, so Tim, if you'd come and sort that out for me. Do we have, whilst he's doing that, any questions from the floor? Thank you very much. Okay, all right. Well, Carol, you sort of briefly touched on ESG investment, and again, you know, we saw from the big risk panel that we had yesterday that only 4% of people at the beginning of the session actually thought that climate risk was one of the biggest risks to think about. And one of our speakers suggested that was something to do with timescales that people were thinking about it in. Could you possibly just expand a little bit more? Because I know that was a bit that you compressed a little.
Yeah, and it, like I said, it is a whole separate conversation and one that's certainly evolving. I mean, we've gone from SRI, socially responsible, to ESG, and I do think it's going to evolve to a real description in the future of long-term value creation and how do you get it. And the reason it's so important to link ESG and time is that is actually where, when you sit in a fiduciary role, you both have the responsibility of generating returns, and everybody feels the dilemma of that with this idea of responsibly allocating capital. And ironically, to do both of those well, and I'm not simply saying it's just about time, but if you extend your horizons, you know the businesses intimately well. It's the same way as you know the manager intimately well, to what James was talking about. You really are invested in understanding those businesses extraordinarily well, and you're highly engaged in the conversation of strategy and what they may need to make big improvements on. That's a description of very solid, good, active management. And again, it's not simply trying to make a case for active management. It really isn't. I guess you could say the same thing with passive, as long as it's dialed up with true engagement on these businesses that you're allocating capital to. I think it's critically important. Investors are heading for a lot of private equity and alternatives, rightly so, because they're frustrated in a way with the public markets. But we need to protect the public markets and what they play out for, not just with shareholders, but to employees, to our communities. I mean, it's the whole chain, and that's what ESG is about.
Thank you. All right, and now that Tim has very kindly sorted out the app form, we have a question on here. Will investors who persevere with an underperforming manager recover all the performance they have lost, or be well rewarded by sticking with them for a market cycle rather than for around 3 years? So, James, do you want to tackle that first?
I think Carol had a nice chart that showed what underperforming managers go on to do in future years. And I think, you know, the conclusion of the chart was that some managers bounce and some don't. You know, so I think, you know, my view is that, you know, active management of listed markets is an extremely difficult thing to be doing, whether you're doing it in a concentrated way or a diverse way or a long-term way or a short-term way. You know, there are not a lot of people who can do that well and consistently over time. So it's really hard. I mean, so if you've got a manager who's underperformed for 3 years, there's a fair chance they're going to underperform for the next 3 years. It shouldn't be a reason itself for just, you know, holding them. So I think that's difficult. But I think just back to what we were discussing earlier, trying to understand that underperformance and place it in context and realise whether it's due to something particular relating to the market cycle and how that's linked together is important. So we as a pension scheme try not to have our investment committee spending too much time looking at quarterly manager performance, of managers in isolation. We like to have the whole of our equity allocation reviewed and the whole performance of that, and then sometimes we can drill down. So this sort of conversation that is, this manager's underperformed for 3 years, let's focus on them and decide whether to fire them, is a particularly unconstructive way of handling relationships with managers. We've certainly had, I have to say, 1 or 2 of those in our experience where we've hired a manager on a consultant recommendation at the top of their performance cycle when everything looked perfect. They spent 3 years underperforming. Some people have left the team. The consultant has downgraded them. The investment committee is worried about them, and you're in a sort of vicious circle of, do you then fire them and replace the new hot manager who's done really well for the last 3 years? I mean, that's just something that we try so hard to avoid. But it's amazing how much pressure there is that pulls you into that kind of decision-making process if you don't really fight it.
Okay. And Carol, your response to the same question?
Well, I think the way James describes is exactly how it happens. It's, it's when negative alpha shows up or underperformance against the benchmark, there's immediate reaction of what's gone wrong. And I think, again, there's so much great work that's done in the beginning of the search process to identify a skilled manager, to really understand that manager intimately. Is the culture supporting what I think I'm buying? It's all that work. What we've seen, especially in the last 5 to 10 years, is that in the monitoring phase, all of that goes out the window. So when you are in a phase of whether it's a 3-year number and it's underperforming the benchmark, is to look at exactly what James said, is where are you in this cycle? Again, the idea of paying for negative alpha seems horrific to people when in actuality, the one thing you want to pay for is counter-cyclical skill, where you're not going to have a manager that's going to chase the herd or chase the benchmark. And so at what point do you really need to be asking the right questions around that and to ensure that you are paying for the skill, the conviction, and that they're allocating capital the way you would expect them to great businesses.
Thank you. Yes?
Jonathan Molan-Smith, London Borough of Hackney. There's been reference to benchmarks. I'm on the pensions committee, and I used to be a pension fund manager, so I've got a bit of buy-side experience. And I'm surrounded by people who are worthy elected members, very decent individuals, but they don't know much about pensions and investment and business and stuff. And it's in particular about benchmarks. We've had a number of situations where some of our managers have not performed well against a benchmark, and they've come to us and they've asked, can we renegotiate, can we change the benchmark to expand the universe or whatever? And we've tended to agree. Could I have comments from the panel about benchmarks and the knowledge and ability of relative amateur pension fund trustees to be able to agree with or discuss professional advice, please?
Thank you. So I can't resist the opportunity to say that the PLSA a few years ago did an excellent made simple guide aimed at trustees on understanding how you use benchmarks. So you should check that out. But that aside, who would like to take this first? James?
Oh, I'm not quite sure of the context of what you were saying. I hate it when people try and come with a different benchmark or say they've done badly against what was represented, but if you just measured us against this, we'd look against cash or something like that. Really, that's a sort of worst warning sign from my perspective. So we use benchmarks. We try not to focus on too much short-term mechanisms. Some manager structures are much more absolute return. But yeah, I think that's one of the worst abuses of the fund management industry is misrepresentation of historic performance, changing numbers. That's the sort of absolute warning signal for me of things that I'm really uncomfortable about.
So to me, you just described the perfect example of alignment or misalignment in really setting out from the very beginning a clear understanding of what the manager's doing. And I feel for so many of the pension funds around the world, because obviously there's so much work involved. But for a manager to come and change a benchmark midstream, to James's point, doesn't sound like they were aligned from the very beginning. And that should be a problem. And with a couple of exceptions, though, that I would say is that as even the global markets have expanded, we've had clients where they bought our EFA strategy, but now they want to compare us to ACWI. And the conversation needs to be really right then and there, very much aligned with what that means to the strategy and how it might be different, that we may not be exposed to emerging markets. But that has to happen. And I keep coming back to alignment. Is people said to me yesterday, well, define alignment, Carol. And I said, alignment is understanding. It's understanding and starting to create trust and being really clear. And that's why I keep coming back to the issue around time, benchmarks. They're basic conversations, but the conversations need to be had.
Yeah, thank you. And I'm afraid that's all we have time for. In fact, we've run a little over, but it was such an interesting conversation. Thank you very much for staying with us here in the auditorium, as well as those of you who have watched online. If you would like to rate this event on your app, please do so. Thank you for being here, and please join me in showing our appreciation for our wonderful panel speakers. Thank you very much.